Hello, thank you for joining Techie Personal Finance Bootcamp. This is a special live event. The stock market's going a little crazy right now. So if you're listening in, you might already be aware of that. If you're not aware of that, and this is something that's news to you, nothing to worry about. This isn't a panic type episode or anything to cause panic. Actually, I want to do the exact opposite. I want to make sure that you understand that, hey, we don't have to worry about some of the chaos in the short term. Want to encourage you to take a long-term approach, and I'll get into a little bit more of the advice moving forward. But what's happening right now and the things that you need to be aware of is there is a lot of stock market volatility due to the recent tariffs that have been announced. And the biggest thing that's causing the free fall that we're seeing in the stock market as of right now and as of this week is, yeah, we knew tariffs were coming in some form or fashion. They've been highlighted and hinted at for a few months now. What really is throwing the market off is that the tariffs that were announced were a lot higher, a lot more substantial than most people would have expected. And so definitely caught pretty much everyone by surprise. And that's why we're seeing the volatility that we're seeing today. But yes, it's unsettling. It's not a good feeling looking at your accounts and seeing red, but I want to kind of put this in perspective for you and kind of take a long-term, bigger picture look at it, because hopefully you're not investing funds that you need today or tomorrow, even the next couple weeks or years even. And so a lot of times what I recommend for clients is if there's something that's coming up, and I have some clients, this comes up pretty frequently with clients where it's like, hey, let's try to just get the most money possible. And we have these things coming up, but we can invest the money and that will get us to those goals faster in the next couple of years. And I kind of pump the brakes on that. It's like, hey, if this is an important goal, if it's important enough to where you guys will kill me or come after me, be very upset, or just be very disappointed if we were to lose those funds, we're not investing those funds. And so I know one particular clients, they have a wedding coming up next year, and they were really gung ho about wanting to kind of get the funds invested. I said, let's not do that. Let's put that in cash. They're investing plenty in their 401ks and retirement accounts. We don't need to also dial up the risk on something that's as important or as valuable to them as far as getting married and honeymoon and all of those different expenses that come up. So hopefully that makes sense there. Another thing to kind of keep in perspective is, yes, right now, year to date, if we're looking at some of the more heavily impacted areas in the stock market, like the tech, if we take the NASDAQ index, for example, year to date, as of a few minutes before hitting the record button, we were seeing that, down 18.75% just since January 1st of this year. So again, not a great situation, but if we want to put this in perspective, well, let's zoom out a little bit. Let's just look 2 years out from where things are today versus 2 years ago. That NASDAQ index, that same one that's down so bad right now since January 1st, it's still up 29.22% for the 2-year outlook. And so still substantial gains if you've been invested in the stock market, been very heavily invested in tech, where a lot of my clients and a lot of folks are. So bigger picture view, not looking at, well, what the heck's happening today, but seeing what's been happening over the years. The stock market has grown pretty substantially over the last few years. And so you should be able to absorb some of this volatility and not be as freaked out of it as the initial headlines that you're seeing, the initial kind of red that you're seeing on what's going on this week, the last couple days, as well as year to date. Comparing this and contrasting this with something else that I'm going to be speaking about when it comes to diversification is, well, let's compare this to something that's a little bit safer that would help if we were to run into a recession, and that's bonds. And so specifically, if we look at just a general U.S. bond index, most U.S. bond indexes are saying, hey, year to date, actually up 3%. So that's a huge deviation from being down 18.75%. But then also, let's look at that 2-year kind of time period too for that. And if we look back 2 years ago, well, the U.S. bonds are actually down 0.4% over the last 2 years, even though it's been doing great this year. And so just kind of gives you an idea of how these different asset classes, different investment choices that you make operate in different times, during times of volatility, just during times of growth. So I think it's very helpful to just kind of step back, look at the big picture, not just the news and headlines of the day, but just kind of overall what's been going on. Um, I highlighted a little bit about the importance of, well, when do you need the money? And throughout the example of my clients with possible wedding, but there could be a lot of other things for you specifically where it's like, yeah, I need these funds. I cannot do with them being 80% of the value that they're worth today or 50% of the value that they're worth today. And if that's the case, yes, the stock market's gone down a little bit, but you might want to consider moving those funds and kind of doing your research. And again, you kind of see it scrolling on the bottom of the live screen, like, hey, this is for educational purposes only, not advice specific to you, because I just don't know enough about your situation. Unless you're a client, then definitely let's have a conversation. But for the most part, I've done a good job at educating my clients, making sure that, hey, any money that we are going to need in the short term, we are putting it in a more safer allocation for them. And then think long term. So if we know that we're not putting our short term goals at risk because we're not investing those funds, we've already kind of keeping that in a savings account, keeping it in bonds, something that's not going to be as volatile. And then you can sleep better at night because we know, like, hey, this isn't going to impact us in the short run. And then just kind of reminding all my clients, let's think long term about this. If we're really not going to need these funds for a long time, is this actually a horrible thing from the investment side? And yes, it doesn't feel good, and it's not it's not going to look good on statements here for the last couple months. But if we're taking a long term approach to this, and you're still working, you're still making retirement contributions into your 401k every single paycheck, you're purchasing all these stocks at a discount over the last few months. And if the values stay down or drop further, either those discounts are going to be even greater or they'll maintain about where they are now. So thinking long term, this actually can be a good thing. And kind of compared to any situation in your life where it's like, I got some really horrible news, but then all of a sudden we turned around and that could have been like the best thing that could have happened to you. That's one possible way to look at investment volatility. Is like, hey, doesn't feel great, doesn't look great, but it actually could be a possibility for even greater growth when the stock market bounces back. One thing I can't do or tell you today is when that's going to be. No one has a crystal ball. And I think one of the huge issues that a lot of people make or think is that they have these crystal balls where it's like, hey, we can get out here, we can get in here. And yeah, if we did have that crystal ball, we were able to predict with very specific timelines of when these things will be occurring, that would be great. Everyone, we'd be millionaires and billionaires if we could do that, because you would be able to time every little movement and just get the maximum out of everything. That's not what financial advisors' roles are. That's not what even the investment management companies that make millions and billions of dollars doing these things. It's not to necessarily try to time these short-term movements. And so you can definitely burn yourself if you do try to time things and then you mistime them, because you have to time when to get out as well as when to get in. And just being off on one of those things by even a small degree, it's like, well, we we ended up losing money. Like, yes, we might have been partially right here, we might have been partially right there, but it was a whole lot to do for nothing. Maybe you end up at the same spot as you would have been, or maybe you end up losing money as a result of trying to avoid losing money. And again, because it's so hard to know when these things are going to happen, we might know what's likely to happen and what possibly could be happening, but when that's actually going to occur, and then if those things actually occur, is very hard to kind of distinguish and kind of put our fingers on, because for every single year for the last 8 years or so, there's always constant news saying, hey, a recession's coming this year, a recession's coming this year. Recession had not came, and we were able to avoid those things because, yeah, there was indications that we could be heading towards that. But what happens with business owners, businesses, and just people is, hey, if we see something coming up, we're going to try to avoid it. We're going to try to get around it. We're going to plan around it. And that's what had happened over the previous years. Every time there was indications that a recession might be falling upon us, is, all right, well, everyone's going to try to avoid those. And we're able to course correct before we ever ran into that. And looking back at volatility that we've seen, we saw a few years back when inflation spiked to over 9%, we saw the stock market fall drastically. Since then, it has recovered. Then the other previous big events before that was COVID situation, things shutting down, people being scared and uncertain about what that future like. In that situation, the stock market recovered very quickly as well, and is way above what the values were even before those drops at that point in time. So definitely thinking long term, not getting too inundated on current events, current news, and I would say avoid thinking that you or anyone's going to be able to perfectly time things. And if we're taking a long-term approach, and if we're like, yeah, retirement's not for 5, 10, 15, 20, some of my clients, it's not for 30 plus years away. And we can be pretty aggressive with that. And no matter what happens over the next couple months, couple years, they're probably going to be better off as long as they maintain employment or able to continue buying in while the stock prices are depressed a little bit right now. So one thing I hinted at slightly is, I threw in bonds and how those are performing vastly differently than what the stock market itself is doing right now. And over the previous few years, being diversified, which is typically the smart, safer thing to do for most folks, has not been as high of a performer. It's still performed well, but not nearly as high as if you were only U.S. stock specifically. And so what you've seen is a lot of people just got, let's just do 100% U.S. stock, or maybe they only picked a handful of tech companies, and those have done really well for you. But what happens is when times do not go well, you do not have some of that buffer and cushioning when stock gets impacted or a specific company gets impacted the way that we're seeing right now. And so diversification, if the stock market stuff is freaking you out and you are diversified, definitely take a look at your accounts, and you might see that you're not necessarily as bad off as the stock market ticker symbols would indicate, because you're diversified. You have foreign investments, which have been doing better year to date, and you probably have bonds, if you're diversified as well, doing better than what the stock market has. And so if that's the case, you're not likely to see a down 18.75% because you are a little bit more diversified, a lot more cushioned. And so when it comes to anything, making sure that what's going on in the world, does that even fully apply to you? And in this case, if you're diversified, you're probably not fully being impacted the way it might seem just from the stock markets being down as high of a percentage as they are, because you likely have those investments elsewhere. And so especially if you're my clients, we've never been too weighted anywhere to be hit the way that some people are being hit right now. And so again, review your investment performance. And yes, it's not going to be great since things are going down, but we're not going to be seeing some of those negative numbers that you're seeing scroll across your TV when it's showing the news about the stock market. So definitely good news for diversification. Now, diversification wasn't the sexy thing to have over the last few years, but it's definitely showing why we do it and why most financial planners encourage diversification. It avoids some of these free fall events that we're seeing now. And so those are kind of all the quick hidden tips, but to kind of sum things up and give you a real action plan is, let's review your situation. What is actually going to impact you? Does this actually matter to you? And so looking at your investments, are they actually long-term? If they're not, you might want to make adjustments for some of those shorter term investments and goals. For my clients that are near retire or in retirement, they do have a lot more bond exposure. I have clients, because investment management is not a mandatory feature to work with me, I do have clients that don't have investment management, and we did just happen to be lucky with the timing of our meeting. I encouraged them, like, hey, you're about to retire, you're very heavy in stocks, let's consider maybe some bond exposure. And they messaged me the day before the free fall started this week, and we weren't necessarily trying to time it, just match up with when our conversation was, knowing that retirement is coming up and just saying, hey, something to consider and look at. And so, for at least a chunk of their investments that they moved out of the stock market, not necessarily for retirement purposes, but more for, hey, your retirement goal is coming up and we're going to need some of these funds as you start to withdraw from your account in the next couple of years. And so it was more based on their plan, their goals, and kind of making sure things are allocated in a way that makes sense for them. So yeah, that's what I encourage you to do. Make sure you have a plan. Make sure your plan makes sense as far as timelines, and really plot those things out so you're not surprised if you were to try to hit the retirement button and maybe your resources don't hold up better over these next couple months than you were anticipating. If you do have time until retirement, again, just kind of reminding you, if you've been listening along, is this actually could be a good thing. So any of my younger clients, especially, like, these types of things occurred all the time for the folks that have retired previously, folks that have successfully retired, and they just kind of kept contributing, kept putting money into their 401k, even if they didn't know how it worked. They're like, yep, I'm making good money. I'm able to put it into my 401k, and the stock market moving around doesn't impact my cash flow. It's not impacting their role. And so they were able to take advantage of various stock market dips over their previous 20, 30 years while they were working, and it allowed them to retire. So definitely don't get stressed out if you're a young person and seeing the stock market bounce around. I get questions all the time. Should I even be investing in my 401k? Definitely, if you don't need the funds, if it's a matter of, well, I'm just going to blow the money on something that's not valuable versus, yeah, maybe we can put it here and try to get some long-term growth opportunity out of it. A 401k is a great opportunity for that, to just kind of Jedi mind trick yourself into doing some good financial stuff. And then I'm sure, hopefully, you still have enough income to where you're able to have a good life, have a lot of flexibility. But yeah, having a long time till retirement means that this is a great opportunity for you and your investments, even though the visual of it today doesn't look good. Just imagine that you just walked into the store and they said, you know what, all the groceries that you were going to buy anyways, they are now 50% off, or just kind of looking at the NASDAQ index specific. So some of those tech heavy companies, those tech companies are 20% off, and you were probably going to buy those anyways, but now we're getting 20% off. That's how to look at it for your 401k if you have quite a while before retirement and being able to need those funds. And then if retirement's close, definitely make sure you're diversified. Make sure you're not too heavily weighted. There's something called sequence of return risk for withdrawals as you retire. That's really the biggest pain and the biggest fear for anyone that hits retirement, is that you retire, the stock market falls 20, 30, 40%, and then you start pulling out and locking in those losses and don't allow the investment to gain that back. That's where diversification will help you pinpoint the things that have not fallen, sell those, allow yourself to buy time to let the investments that have fallen get back and grow from there. So hopefully this gives you a little bit more understanding as far as how this might impact you specifically. And hopefully at the end of the day, you're not as exposed as you may think. And then this might be a great opportunity for you. Who knows if the stock market falls further? Who knows how quickly it will bounce back? But if your investments are long-term, I tend to feel pretty confident as far as what humans are capable, what the U.S. is capable in particular, just as far as being resilient, being growth-oriented, and having challenges thrown in front of us and being like, you know what? Yes, it's going to be a little bit harder, but we'll figure it out. We'll be able to find a way to kind of prosper and come out stronger and better than before. No different for that than our investments, and kind of thinking that, hey, people will figure these things out and we'll be able to navigate these things, if not in the short run, in the long run. And so if you have a similar opinion and belief that, hey, things tend to get better, even if there's choppiness and even if there's some chaos in between, then sticking to a long-term investment strategy, a long-term financial plan, and being grounded in that financial plan should hopefully give you the ability to sleep more peacefully at night and be able to navigate these choppy waters right now. If you're a client of mine, reach out if you have questions, still have some concern. If you're not a client of mine and just kind of need someone to kind of check in and have conversations with you, I know I'm pretty busy right now with tax season, but I might be able to share some emails and messages in between meetings and things like that. So feel free to reach out. Happy to help however I can. All right. Thanks for joining, and let me know if you have any follow-up questions to this.